Hi, I'm Suzy Rhoades with PassMasters. Welcome to this week's Questions of the Week. This week, we're going to do a section exam from the Series 6 exam. Provides customers with information is the name of this section. Let's take a quiz from within our learning management system. Which debt instrument would have the highest coupon rate? Fannie Mae, TIPS, Treasury bill, or Treasury bond? So the one that has the highest risk would have the highest coupon rate. TIPS, Treasury bills, and Treasury bonds are all direct debt of the U.S. government. Fannie Mae is not direct debt of the federal government. Fannie Mae is the one that would have the highest coupon rate of those four choices. A stock has a current market price of $80.50, so $80.50, and a PE ratio of 10. That means that the company's earnings per share must be, well, the market price is 10 times earnings per share. So $80.50 divided by the PE ratio of 10 gives us earnings per share of $8.05. So you can always use your calculator for that. I don't expect you to be able to do that in your head. Regarding taking a loan from a variable life insurance policy, which of the following is incorrect? Loans must be made available if the policy has been in force for at least 3 years. That is true. If an outstanding loan causes the policy's cash value to become negative, the insured has 31 days to make a deposit into the account so that it has a positive balance. Otherwise, the policy will lapse. Loans must be made available from the very beginning of the policy. That is incorrect. So that means B was true. The minimum loan amount that must be made available is 75% is true. So loans, you have to have a positive cash value in order for loans to be made available, and that is generally not the case for the first 3 years. When a company owns marketable securities, the interest income and dividend income is found in which component on the statement of cash flows? Marketing activities, investing activities, operating activities, or financing activities. So the company has invested in other companies' marketable securities. Interest income and dividend income is found within the investing activities of the statement of cash flows. A broker-dealer's articles of incorporation must be kept for how long? Forever, 3 years, 5 years, or the life of the firm? For the life of the firm. A country is experiencing a political uprising. This is an example of legislative risk, political risk, regulatory risk, or sovereign risk. That sounds like political risk to me. A political uprising or a coup. An investment manager for an index exchange-traded fund attempts to mirror the performance of the index, charges a higher than average management fee, will return twice the index, or would like to beat the index. So if you're an investment manager for an index fund, your job is going to be to attempt to mirror the performance of the index. They have lower than normal management fees because they're not actively managing the portfolio. When selling shares, an investor must use first in, first out, must use last in, first out, must choose the method for determining the cost basis, or must use the average cost basis. When selling shares, an investor must choose the method for determining the cost basis. So they have to choose the method, or the mutual fund company will choose a default method. So it's up to the investor to notify the mutual fund company because they will keep track of an investor's cost basis today. Which is the best description of repurchase agreements? A form of short-term borrowing for dealers in government securities, money market instruments sold by commercial banks, long-term debt issues of the United States government, the rates of which are published weekly, or letters of credit used to finance international trade. So repurchase agreements are money market instruments. They are a form of short-term borrowing for dealers in government securities. So I forgot to show you, when you believe you have the right answer, you click check answer, click show explanation. You can read the rationale. So a repurchase agreement is often called a repo, a form of short-term borrowing used by U.S. government dealers. The dealers sell U.S. government securities to investors with the promise to buy them back the next day at a slightly higher price. So that is what a repurchase agreement is. Many of my students are auditory learners, so you can always listen. So all of our questions have audio explanations for you. Classical economists believe that higher taxation and less government spending should be used to get the U.S. out of recessions. Less government regulations is key to getting the U.S. out of recessions. The quantity of money in circulation determines our ability to rise from a recession, or less government spending is key to stoking the economy out of recession. Classical economists, they are the laissez-faire approach. They believe in less government regulation. They believe in the free market, that the free markets will provide. Which of the following would qualify for breakpoints? Purchases made into growth funds at different mutual fund companies? No. Purchases made into the same mutual fund, even though made at different broker-dealers? Purchases made into two different mutual fund companies? No. Purchases made by two unrelated persons? No. So a breakpoint. If the purchases were made into the same mutual fund, even though they were made at different broker-dealers, they would qualify for a breakpoint. Not different mutual funds, but the same one. A breakpoint is where you've invested enough that you finally get a reduced sales charge. Your client is excited to buy a stock in anticipation of receiving the next dividend. You would need to explain all of the following except, so what do you not explain? The dividend is tax-free. Do not explain that. The dividend is not tax-free, so I'm pretty sure that's going to be the right answer, but let's check the rest. The cost of the dividend is included in the price paid for the stock. Yes, makes no sense to buy the dividend. They're going to pay for the dividend, basically. It's included in the price of the stock. The price of the stock will be reduced by the amount of the dividend as of the ex-dividend date. Yes, so it makes sense to wait. Don't get the dividend. Don't pay the taxes. If they instead wait to buy the stock until after the ex-dividend date, they will pay less. That is true. So do not explain to them that the dividend is tax-free, because that is false. That is not a true thing. Which of the following is incorrect regarding annuities? There is no sales load. That is incorrect, but check all four choices. Once a contract is annuitized, payments continue for the life of the annuitant. That is true. The premium is paid in with after-tax dollars. That is true, unless it says that it is a TSA or a 403B. Those are the tax-qualified annuities funded with pre-tax dollars. There are early withdrawal penalties for withdrawals made under age 59 and a half. That is true. So, which is incorrect? There is no sales load. There is a sales load in an annuity. Barry invested $50,000 into a blue chip fund on December 1st. On December 15th, he received a $2,500 long-term capital gains distribution. How is this distribution taxed? Ordinary income, tax-free if automatically reinvested, short-term capital gain, or long-term capital gain? Well, let's see. Barry didn't have it very long, but that doesn't matter. It is a long-term capital gain. His holding period is just there to trick you. Long-term capital gain distributions are taxed to the investor at long-term capital gains rates. Income taxes owed on a trust are filed on Form 1040 is your personal income tax return. 1065 is for partnerships. 1041 is the income tax form for income taxes owed on a trust. So 1041 or estate. Form 706 is the estate tax return, but the estate's income tax return would be 1041. So 1041 is the income tax return for trusts and estates. Form 8K is oftentimes referred to as a current report, is due within how many days of a significant business event? It is due within 4 days of a significant business event, the current report. Which is a benefit of investing in a REIT? REIT stands for Real Estate Investment Trust. Greater price volatility than direct ownership in real estate. Dividends are taxed as ordinary income. Lack of control, or properties are selected by professionals. We're looking for a benefit of investing in a REIT. Well, that is the fact that properties are selected by professionals. I mean, I would love to buy a bunch of properties myself and manage them myself, but what do I know about doing that? So that is a benefit of investing in a REIT. Restricted stock are prohibited by law, never sold, shares of stock that are not freely saleable or freely saleable. Restricted stock are shares that are not freely saleable. So restricted stock, oftentimes you see it when you purchase shares of a private placement under Regulation D. You either are purchasing shares of a reporting issuer or a non-reporting issuer. When you buy shares in a private placement, you are buying unregistered, non-exempt securities. So if it's a reporting issuer, you have a 6-month holding period. So you cannot sell those shares for 6 months. If it's a non-reporting issuer, you have a 12-month holding period. So restricted stock, not freely saleable. Absent a time period to keep books and records, FINRA rules require members to preserve the record for at least 2, 5, 4, or 6 years. So if there's no specific time period to keep the book or record, then it is a 6-year holding period or time period record retention requirement under FINRA rules. The relative strength index is used to measure which of the following: market breadth, market sentiment, market momentum, or market return. The relative strength index is used to measure market momentum. The capital asset pricing model is used to help the investor determine an asset's expected return, holding period return, current yield, or cost basis. It is the capital asset pricing model that will help us to determine an asset's expected return. So we're going to look at the risk-free rate of return, and we're going to add that to the investment that you're considering's beta. Take that, multiply that by the expected return of the market minus risk-free return. So it is, if you're an investor taking on higher risk than the risk-free return, you're going to demand a risk premium. So the capital asset pricing model, when we're looking at the security market line for an individual security, we're going to determine the investment's expected return. We're going to use beta to account for the additional level of risk. It's not a guarantee of anything, of course. Which of the following investments is most suitable for a client in a high tax bracket? Mutual funds, options, stocks, or municipal bonds? High tax bracket, which one of these has federally income tax-free income? It is municipal bonds. Interest paid on a municipal bond is tax-free federally. It would be taxable at the state level unless the municipal bond was from the same state that the investor lives in, then the interest income will be double exempt. The Black-Scholes is a pricing model for futures, options, warrants, or forwards. The Black-Scholes is a pricing model for options. Regarding financial eligibility for students, which of the following is incorrect? Having a 529 balance in a child's name is more detrimental than having it in the parent's name. Money balances in the student's name have a detrimental effect on the expected family contribution. Balances in a 529 plan have less of an effect on financial eligibility than having money in a child's name. That's definitely true. Money in a 529 plan, whether it is in the name of the parent or the student, is treated as a parental asset. That is true. So which one of these is incorrect? Having a 529 balance in a child's name is more detrimental than having it in the parent's name. That is incorrect. So when you're doing that FAFSA form, the financial aid form, you will be really dinged for having any money in the child's name or in the student's name. If it's a 529 plan asset, whether or not it's in the name of the parent or the student, it doesn't matter. It has the same effect on their eligibility. It is treated as a parental asset, even if it's in the student's name. Esperanza has purchased a variable life policy. Which of the following risks should she be most concerned about? Inflationary risk. Well, no, variable life is going to keep pace with inflation because the money is going to go into the separate account, which is invested in something like a mutual fund. So invested in the stock market. Interest rate risk, credit risk, or market risk. Well, it's invested in the stock market. So of these risks, she should be most concerned about market risk. It is true, though, in a variable life policy that the minimum death benefit is always guaranteed. So when you're done, you click Finish Exam. Thanks for taking the quiz with me. We got 100%. We're going to click our score report. You can see that these topics are within Section 3 of the Series 6 content outline, which provides customers with information. And then you click and you can see all of the different topics. So these are all of the different topics that we cover within the Series 6 course, because these are topics that are found in the content outline published by FINRA. That's it for this week's Questions of the Week. I hope you learned something. Be sure to give this video a thumbs up, subscribe to our channel, and turn your notifications on. If you have any questions about this video, ask me in the comments below. If you'd like to check out PassMasters course offerings or to enroll in any of our programs, there's a link found in this video's description. I hope to have you as a student soon. Keep up the good work. Happy studies.
You got this.